Good morning, everyone. Thank you for joining us today for a webinar on Massachusetts paid family and medical leave. I am Tom Piscino from Arch Insurance, and I'm joined here today by Jim Iannicelli, who heads our disability underwriting. The intended audience of this webinar today are brokers licensed in Massachusetts for accident and health who want to learn more about the recent law passed in the state for paid family and medical leave. You will see a box at the bottom of your screen to type questions. We will address questions at the end of the presentation. So today we're going to do a quick overview of the law, the benefits, who's covered, who pays for it, options for employers, the solution that Arch is offering, and the opportunity that this presents for everyone today. Okay, so as I go forward here, you can see now on your screen that we overview the Massachusetts PFML law. So paid family medical leave establishes a system for paid family leave for up to 12 weeks of family leave and up to 20 weeks of personal medical leave for an employee, for a total of 26 combined weeks for both. Now, we have a lot of people on today who work with us today in New Jersey and in New York. This plan is very similar to those plans where you have essentially an STD component and a paid family leave component. It is also similar to New Jersey in that all employers are automatically put into a state-funded plan for benefits. And then we'll talk about the options for employers and how they can opt out of that plan. There are some dates here in the grid that are very important, and we are going to go through these in detail in the presentation. But this came on very quickly. So the final regulations on this Massachusetts law were released on July 1st of this year. That's when a lot of us and the employers in the state really learned on how this was going to work. Employers in the state just passed a deadline of September 30th, where they had to post written notices to their workforce about the PFML law, the benefits, contribution rates, and other provisions. There's a date we're going to talk about going forward, which is December 20th, which is a deadline for applying for a private plan exemption. January 1st of this coming year in 2020, where collected contributions are due to the state, and then January 1st, 2021, when most of the benefits begin. And like I said, we're going to go through these in detail as we go through the presentation. So what are these leave benefits? So beginning January 1st, 2021, employees in the state will be able to receive up to 20 weeks of paid medical leave in a benefit year for their own serious health condition that prevents them from working. So essentially, this is STD. And we see this in New York and New Jersey today, called TDI or called DBL, but we see it today, and many of us are familiar with that. The employees also have the ability to take paid family leave up to 12 weeks related to the birth or adoption of or foster care of a child for various military reasons when a family member is going out on active duty. And there's also an additional component here that we didn't see in the other states, which is up to 26 weeks of benefits to care for a family member who's a covered service member with a serious health condition. Later in 2021, on July 1st, an additional benefit becomes available, and that's for taking up to 12 weeks to care for a family member with a serious health condition. In total, an individual can take no more than 26 weeks in aggregate of any of these above leave. In 2021, the maximum benefit payout is $850 per week. So who's covered under this law? Well, it's basically everyone that is paid by a Massachusetts employer. There are some exemptions. Municipalities are exempt, but they can opt in to cover their employees. There are certain contractors that can be covered under the law, if they are 1099 and that employer is 50% or more of their workforce is contract employees. And it's also available to self-employed individuals in the state who want to opt in. There's also a job protection component that this is for the employers to really pay attention to, that if an employee is out on one of these leaves, they're able to return to work with an equal position, equal pay, same status, employee benefits, seniority, et cetera. So who pays for this? So like I said earlier, the state has put together a state fund that will collect contributions from employees and employers, and then starting in 2021, we'll start paying benefits from that. So the state put together this nice graphic here, which really explains the contributions. So at the top here, the total contributions are 0.75% of the eligible wages. And those eligible wages are capped at the Social Security cap that's followed federally. So in 2019, that's $132,900, and in 2020, it's $137,700. On the right side, the family leave contributions, that 0.13%, that's fully funded by the employees. So you can see all the way to the right at the bottom, 100% of family leave is covered by the employees, and none of the contributions coming from the employer. On the left side, on the medical leave portion, which essentially is the STD portion, you'll see it's a larger percentage, it's 0.62% of eligible wages, and that amount there is covered 60-40 by the employers and the employees. So the employer does pay a large portion into this plan. This graphic here is for employers with 25 or more covered employees. For those with less than 25 employees, the contributions are a bit different here in that the employer is not funding any part of this plan. It's fully funded by the employees. They're paying the same amount, the employees, as if they were working for a larger employer. There's just no employer funding on this particular piece. So if we look at where those contributions go, the way the law is written is that employers need to start taking contributions from their employees starting this quarter, the fourth quarter of 2019, and forward. So they will start contributing right now. They're collecting the contributions right now, and will pay them in January of 2020 for the fourth quarter of 2019. And we'll continue to pay those all the way through as long as they are continuing to use the state for their benefits. As you can see, in 2021, that's when the actual benefits begin. So what the state is doing is collecting 5 quarters of contributions up front to fund the state fund, so that in 2021, they'll have the funds available to start paying claims. The contributions from employers are due 30 days after the end of each quarter. And again, I just want to repeat here that employers with fewer than 25 individuals, they are not part of this contribution, although they still have to remit the contributions collected by their employees. So as I mentioned earlier, similar to New Jersey, Massachusetts has built into the plan the ability to have a private plan and gain exemption from the state fund. So what this means is that Massachusetts employers that offer a private plan with a paid family leave benefit that's equal to or more generous than those provided under the Family Medical Leave plan by the state can file for an exemption. The benefits must be approved by the state. That must be greater than or equal to the benefits described in the law that I described earlier. And the private plan must not cost the covered individuals any more than what they would pay if they were with the state. And like the state plan, the private plan benefits must be available at the beginning of 2021. Employers who receive a private plan exemption are fully exempt from making payments to that state fund. And that includes the quarters leading up to 2021. We're going to go into this in a few seconds. So what are the exemption options? So an employer can be exempt if they have a privately purchased insurance plan from an approved carrier. So basically the plan that they are replacing the state plan with must be approved by the state of Massachusetts, must meet or exceed the benefit requirements, and must be effective on January 1st, 2021. Employers also have the option to self-insure a plan, which has the same requirements as an insured plan, but they are required to post a surety bond, and they must have some ability to process claims. And both of those exemptions are managed and submitted through what Massachusetts has in place called Mass Tax Connect, which is a website that employers have a login into, and they can go on there to gain their exemption. I'll talk about that in a few minutes. So Arch's private plan. So we've been working on this since we learned about how this law was going to work. So we are fully compliant with the state of Massachusetts. We have filed with them and received approval to go forward and offer a plan to Massachusetts employers. The Arch product is sold standalone, so we do not require any other products to be required to purchase a plan from us. Companies who opt out of the state plan with Arch will not be required to make quarterly contributions to the state fund. Once you're exempt from the state fund, you're exempt. You no longer have to remit any contributions to them. Each policy that we put out is fully underwritten. Excuse me. Is fully underwritten using company-specific demographic and employee census data, gender, date of birth, and salary that we will look at and underwrite and present a rate for each of these for each employer sent to us in a quote. Our rates are guaranteed for 1 year. And the Arch premium is collected in arrears after the end of each quarter. We do require a minimal additional premium to bind coverage at $25 per employee, and we base that off of the number of employees upon quoting.
And Tom, just real quick on that minimal initial premium requirement, the $25 per employee would cover the cost up until the 1/1/21 effective date. That's not a quarterly amount due. That's a one-time per employee premium that we would require.
Right, and we will credit the we will credit that amount on the first quarter premium in 2021. I just have a small caveat here at the bottom that our private plan specifics are subject to change to comply with any new refinements or definitions from Massachusetts PFML law. The only reason we put that in is because this has happened so quickly, and the state has been putting out further refinements on the law as we go along here. So this is probably the biggest attraction for employers right now. If you are with the state plan, you need to send 5 quarters of contributions in prior to benefits beginning. But if you opt out of the state plan, you no longer have to send in those contributions either to the state or to us. So an employer's first obligation to make a premium payment is after the first quarter of 2021. So you can imagine this can be a significant savings for employers who opt out as well as their employees. Arch bills quarterly in arrears. So at the end of the first quarter, the employer will receive their first invoice from Arch, again, credited with any upfront premium that we've collected. And then they will receive a quarterly in arrears bill from us on a go-forward basis. But I think the biggest point to note, and I go back to it, is this slide here. There can be a very big savings for employers, and we're going to go through some examples of employer sizes and the type of numbers that we're speaking of here. So how do you get a quote from Arch? So many of you have received it, and if you haven't received it, we'll send you this. We have a quote sheet. It's a simple gathering of some information. We do require an employee census for all employees. It's gender, date of birth or age, annual salary and occupation. You send that to, if you have our direct email addresses, send it to us, or to our general email address at diunderwriting@archinsurance.com. Arch Underwriting will release a quote within 2 business days containing a total contribution rate based on the census data provided. Important to note that Arch is not quoting cases under 25 lives.
And Tom, not to be nitpicky, but I just would like to put out there that if we can get that census data in Excel format, that helps us tremendously because we have to be able to cap employee wages, and if it comes in PDF, we're not able to do that. So
yeah, good point.
That would be very helpful.
Good point. We do have one caveat at the bottom, is that we do reserve the right to reevaluate rates in the 4th quarter of 2020, because demographics of an organization can change in the next year, and we would like to take a look at that to make sure that we're still covering the same rate. So this is what we're talking about here. If we remember the graphic that we showed earlier on the total contributions, the 0.75% is the state rate. That's the rate that they've come up with, that all employers in the state have the exact same rate, regardless of the makeup of the company. So we're looking at this and saying, okay, we're going to look at the employees that make up the company, we're going to underwrite that, and we're going to, that rate then could fluctuate up or down from there. Now that rate when you're paying to really the state or to Arch, the employer has the option. The employer can pay the full rate and not take contributions from the employees. However, they can never charge more to the employees than what you can see here on the graphic, the percentages there.
Yeah, and I would just add to that, if the employer wishes to, they can pass along some of the savings to their workers. The only thing they can't do is charge the workers more than that 0.13%. That's just in case you're ever asked that.
Right. So that's the piece that we'll be underwriting, and I know there's some of you that are on that have already received quotes from us. We present back a rate, and that's the top rate there that we are that we're then presenting. So what's the employer exemption process? Massachusetts has made this fairly easy. So an employer who has received a quote from us and then wants to move forward, they fill out we just complete an application. We will then release a declaration letter from Arch that will have a policy number on it. and this letter is already approved by the state, and so that the employer will then use this to go forward and receive exemption. They will log into the Mass Tax Connect website and complete the filing process for exemption. There is a set of questions that they must answer. A lot of that, I've reviewed the questions, and a lot of that has to go into what we had said earlier about some of the job protection abilities that are in the law to make sure that the employer is following every piece of the law. They then have to upload the policy declaration letter as proof of coverage starting on January 1st, 2021, and then wait for exemption from the state. And to date, the state's been fairly swift on this and has been responding back quickly to employers. Now, this is where the December 20th date comes in. So there's a deadline for filing for a private plan exemption for the first quarter of contributions. So what that means is that an employer that wishes to become exempt from the state plan and has, received a declaration letter from us, they must go and apply by December 20th and then receive exemption. And that means they will not be required to submit to the state any contributions they collected in the fourth quarter of 2019 or going forward. That then gives them the ability to not have to remit any more or any contributions to the state. And that means that an employer who received exemption by December 20th is exempt from those 5 quarters of upfront contributions. Now, the department will continue to accept applications on a rolling basis after December 20th, but at that point, the applications must be approved in the quarter prior to that they would go into effect. So, for instance, if they miss the December 20th date, they could then file for exemption starting in the first quarter of 2020 and then forward. So while December 20th is an important date, because that would give the employers and the employees 5 full quarters of not making contributions, they still can, going forward, have 4 or 3 or 2, going down quarters of exemptions. But this obviously gives them the biggest advantage. So let's look at some examples here of really what we're speaking about. We put together, 3 different size employers. So employer A here is 50 employees with an average salary of $60,000 per year. So doing some quick math here, $60,000 a year is $750,000 of payroll per quarter. Multiplying that by the state rate, they have a contribution of $5,600 that they would pay to the state plan. If we multiply that by the 5 quarters, this employer here, that's $28,000 that they would send to the state in contributions in those 5 quarters. The employer's portion of that is almost $14,000. So that could be the savings in those 5 quarters just for a 50 life employer. If we look at employer B, 150 employees with an average wage of $52,000, we go through the same math, and you can see that the contribution savings is approximately $73,000 and almost $30,000 just for the employer. So now we're starting to talk about some real dollars. At employer C, a 500 life employer with, again, an average wage of $57,000, doing the same math and using the state rate, 5 quarters of contributions would equal over $250,000, or $100,000 of that is paid by the employer. Now, we use these employee averages because the average annual wage in Massachusetts is around $68,000. So these are very real numbers. When we start talking about savings like this, this is why a lot of employers are really, this is really perked up and come into their focus because there could be a lot of money to be saved here. And don't forget, we're underwriting the accounts. The state is not. So if you have an employer who, could have favorable experience, they'll have a rate that's less than what they would be paying with the state. So on a go-forward basis, so the best opportunity, right, is in the fourth quarter of this year, because an employer could save 5 quarters. But let's say they go forward and they miss the deadline and they're going to save 4 quarters. That's still a lot of savings. Even if they get, go halfway through the year and they save 2 quarters, it's still a savings. But for those that have a rate that is less than the state rate, even if they opt out of the state plan inside of 2021 or 2022 or going forward, there's still a savings there. We do this in New Jersey today, where we underwrite cases and offer less than what they would be paying by the state. And there's many employers in New Jersey who take this route and pay less than they would pay with the state plan. It's unknown yet how well Massachusetts will be paying claims. We do have experience in other state plans where their claim service is less than optimal, and that's one of the reasons, and for certain employers, a major reason why they want to go to a private plan, because of our claim service. So just to recap here, so why would an employer want to come to Arch? We have a history of success in these state-mandated plans. We write a lot of this business in New York and New Jersey. Like we said earlier, the plan in Massachusetts is very similar, with the exception of a few benefit differences. So we have a history of working with those lines and kind of the ins and outs of what a state plan requires. The Arch product is sold standalone. I know that there are other carriers out there who write many of the other lines who are requiring that an employer have other lines of business with them. But in that case, we are writing standalone here. We have a very fast turnaround of quotes. Usually within the same day or within 2 business days, we're turning around quotes. We pride ourselves on our claim service. Most of our claims are processed within a few days. And if there's any issues, we're getting on the phone with employer, employees, or physician if there's something that we need to work on to make sure that the claim is processed as quickly as possible. And of course, the Arch financial strength is very important to many employers who are shopping policies. So what we'd like to do at this point is really open it up to any questions that you may have. We may have gone through this kind of quickly, and to some of you, you've heard this before, and others, this is brand new. So let's just run through a couple of quick questions here. We have one here that says that what if an employer opts out in 2019 and then goes back to the state plan in 2021? Well, what happens in that case is that the employer is required to pay the quarters that they didn't pay to the state while they were opt-out. So if they were if they were exempt for 5 quarters and did not pay into the state plan for 5 quarters, and they wanted to go back into the state plan, the state is going to ask them for that money, and the state will not allow the employers to go back to the employees for those contributions. So it's really going to be on the employer at that point. We have another question here. Are part-time employees covered? And yes, they are. They are covered under this plan. Let's see here. If Arch underwrites a case and the rate is higher than the state plan, why would an employer take it? Well, let's see. Really, in that case, the employer, if they opted out this quarter, the employer is still going to receive those 5 quarters of savings. So if they could do that math pretty quickly and see the benefit, of being out of the state plan. It really comes down to the employer, but I think the point here is present the rate, because like I said, there's those 5 quarters of not making those payments. you present the rate and really let the employer decide.
So here's another one. How is Arch able to offer these savings for the 5 quarters? Well, basically, the state they have to start from ground zero. They have no infrastructure whatsoever. Part of those funds are reserved for claims, but a lot of those upfront contributions are to set up systems, hire staff, so on and so forth. Arch already has the infrastructure in place. So basically all we have to do is, treat it as a new product, and our existing infrastructure is able to handle those upfront costs.
Yeah, good point. Good point. Let's see what else we have here. Well, we covered this earlier, but I think it's a very good question. What if an employer misses the December 20th deadline? Like we said earlier, they can always file with the state for exemption. They will just not, they will still have to make the contributions for the quarters that they were not exempt, but then once they're exempt, they no longer have to make those contributions. This must be from one of our local brokers here. So why is Arch asking for a census in Massachusetts? This is different than New York. New York presents us with a rate for paid family leave. Here we are underwriting the paid family leave along with the short-term disability. So it adds a higher level of risk that we need to account for, and having the census allows us to evaluate each risk much more accurately. I think it makes Jim much happier as well.
Yes, absolutely. Yeah, and because there is no prior experience, so we have to rely on group demographics to be able to price the account accordingly. So.
Right. Those are the questions that we have. If no one else has anything else, let's see here. I'm just making sure that we don't have anything here. Okay. Okay, so really going forward, if you do have further questions, you can always reach Jim or I. Here's our email addresses and phone numbers. If you don't have the information already about how to quote, we'll send you the Massachusetts quote sheet. We also have marketing material, a product sheet that you can use as well to sit down with employers and explain this. But we are seeing activity, and this is becoming quite large for employers up in the state. There's a lot of broker activity right now, a lot of talking. We're getting a lot of questions. We're getting a lot of quotes in. So, now is the time to act, obviously, before December 20th. And we're here to help you. Call with questions, anything at all, because I know it can be a little confusing, but we can certainly walk you through it. Okay.
Yep.
So we want to thank everyone for attending today. We are going to send this out. So I'm sure there are people in your office who have missed it. We will send out a link so that others can get online and view and listen to the webinar. And that's it. I want to thank everyone for attending.
Thanks so much, everyone.
Okay. Bye-bye.